Hey everybody, it's Shannon from alphatrends.net. Today is Friday, the 3rd of May, 2019, and markets were basically positive this week, largely due to today's gains. We did see the Dow, oil, and energy lose a little bit of ground. Let's take a look at the charts as we always do. And as the S&P 500 continues in this uptrend, today was a new all-time record closing high. We can see that with more clarity here, of course, on the weekly time frame. And on the daily time frame, back to that, we held above this rising 20-day moving average. So we are still firmly in an uptrend. Now, we did have a little bit of a pullback earlier, just yesterday, that is, on Thursday. As we broke down, we came right to the volume-weighted average price from the beginning of April that we've been looking at. That's that blue line. And that's kind of what I projected in a Twitter post on Wednesday night. I certainly didn't expect it to bounce back this quickly and come up back above the rising 5-day moving average, but this shows why. You simply, if you're going to short in an uptrend, you've got to be super quick, and it really just does not make sense. The path of least resistance continues to be higher, and we have longer-term moving averages and trend lines that continue to show us that, again, the path of least resistance is higher. The NASDAQ closed also at a new all-time high on this weekly chart here, so we added a little bit of ground this week. It was up about 30 basis points on the week, but same story. It was the volume-weighted average price from the beginning of April that we've been looking at that held as support. First, we broke this volume-weighted average price right in here, and now we're back above everything and looking like the market is poised to continue to move higher. This week's low and that volume-weighted average price will continue to be the important level to keep an eye on in the S&P 500 and in the NASDAQ. Now, the Russell 2000 has been really pretty choppy here as it has been recently trying to break out. Today, we had a definitive breakout above this prior band of resistance, and this is what we've been looking for. We've spoken about this larger head and shoulders pattern, but within that right shoulder, we also have this inverted head and shoulders pattern, and it looks like the Russell 2000 is likely to continue to move higher. This is probably the best market for further upside from here, up to that 163 to 164.5, 165 level looks quite obtainable here. The thing I would say is be careful about how you buy the Russell 2000, because as I've pointed out, we've had these big rallies like this, and for the people who chase them, a lot of times they see that it quickly evaporates. But the key here is that, again, we held a key volume-weighted average price level, and that was from the March 25th low that we've been looking at here for the last several weeks. That did hold also with this prior low. So the most important level is 155.5 for the buyers to maintain control. But right now, that's a little bit far away that we really don't have to consider that too much, I don't think. So what we'll be looking at is, pulling back and creating a healthy pattern of higher highs and higher lows. Semiconductors this week, they did actually gain some ground, 1.63%. We started out, a little bit weak here, but still higher on the week, and also holding that rising 20-day moving average, as well as the volume-weighted average price from April 1st. We continue to maintain above that. Intermediate term, we're kind of stuck in a little bit of a range here, but we're above a rising 5-day moving average. We have the buyers in control, and the first level that I would think that we would want to be a little bit more cautious on the intermediate term would be 115. As long as it holds above 115, I think that the surprise would be is if that the path of least resistance remains higher, and the benefit of the doubt should continue to go to the buyers as long as we hold above that 115 next week. Now, the Biotech's gained some ground here today, and this one is, I pointed out on Yahoo Finance, what we have here is a little bit different than the rest of the market in that, let's just start over with a clean slate here. And what we'll see is this is the year-to-date volume-weighted average price. That's that blue line. The other thinner blue line is the 20-day moving average. The green line, the 50, and the black, of course, is the 200. We're below all of those moving averages, and those moving averages are declining. So when we look at the weekly time frame, here's a trend line that we had bounced off in December. And if we go back to that daily time frame again, what I'm going to do is add a volume weighted average price right here. And we'll just you can see that that's the purple one. We're still below that. So this is really, as long as we're below 110, I think you have to be very careful with these biotechs. Near term, it's encouraging a little bit that it made what looks like a higher low and slightly higher high. But the point here is that this daily chart still shows the potential for a bigger decline. And if that were to unfold, I certainly, if you are involved or if you've recently purchased, I think that your stop probably has to go underneath this week's low. But I do not suggest a long position when it looks like this. I'd rather be in the sidelines in cash, waiting for a better opportunity to emerge. And the better opportunity, as we've been speaking about for several weeks, is the financials. The financials continue to do well. They closed at a new recovery high, not an all-time high, but recovery from the December lows. And we see here that, again, this inverted head and shoulders pattern, the neckline was broken, this prior resistance in here held as support, and this market continues to march higher. The key this week was the volume weighted average price from this most recent gap here that was on the 12th, I believe, that we saw that continue to hold, and buyers are still in control. We saw a little pullback below the 5-day moving average, but the 5-day moving average is advancing throughout that, so there's no reason to look at this market as having any type of problems. Next week, I think the most important level we'll want to see hold is probably 27.50. As long as we remain above that, any type of counter trend trade should be considered just a short-term pullback. Let's take a look at Apple too, because going into the earnings, Apple came right down here. Let's clean that up. I was showing someone that the other day, but Apple came right back down to the April 1st volume weighted average price as well. So we saw that, again, a key level that has been important for, since the beginning of the month, held once again on a closing basis. Then after they reported earnings, it was higher once again. So Apple continues to march towards its all-time highs here. It's just been a phenomenal uptrend that's been holding the rising 20-day moving average. If nothing else, use 2 closes below the 20-day moving average is maybe your stop if you're a longer-term investor. But a lot of people think a stock like Apple is bulletproof, but then they saw that it does decline, as do all stocks. And how much comfort do you have holding those during those declines is obviously up to you. Google, we saw, did get hit on earnings, and this stock came very close to the year-to-date volume weighted average price. It got marked up ahead of earnings and then pulled back, but still, I think for longer-term positions, that you're above the year-to-date volume-weighted average price, you're above the 200-day moving average, and this prior resistance in here should hold as support. If it breaks below that, that's where there might be troubles, but it looks like a short-term setback for Google after a push to all-time highs ahead of those earnings.